Hey there, and welcome to Invest in Square Feet. I'm Matt Shields, and today we're unlocking the secrets of successful passive investing with a guest who has over $1 billion of assets under management. You're not going to want to miss the inside information that he gives us. If you've ever wondered how to tackle syndications like a pro or how to build those game-changing connections in the investing world, you're in the right place. This episode is going to teach you the tips and strategies that will give you the edge in your investment journey. So let's dive in and get to work.
Yeah, I wasn't married at the time, and I had a lot of free cash flow coming in. So I was able to make a lot of bad decisions. Some of which would be joining a few of these stupid like guru groups where they teach you to be a multifamily millionaire,
Yeah.
right? And I guess I played the part too. Like a lot of people were young, like my age too, and then you have some older guys too in their 40s and 50s in those types of groups. But the only person who gets rich in that stuff is the people who put on those
Put it
training
on, yeah.
programs and take 30 grand, 40 grand from people for those platinum training programs.
Yep.
I'd say a lot of that you could have. I don't know if there's a book for this type of stuff. I don't want to. I poke fun at it a lot of times, but a lot of information. Yeah, you probably could have learned this on YouTube or elsewhere. But today we have an e-course for passive investors to learn about due diligence for free. We give away to our folks, but at that time, maybe they didn't have this stuff readily accessible. But I think the value that I did get was I got around the right people, right? This crucible of other young people, entrepreneur people moving in that same direction. In a way, you got to pay to play. You got to pay to get in the right rooms. If not, you're just messing around with the broke guys at the local real estate
Yep.
club,
Yep.
like I
Yep.
said, or the internet forums, which is probably worse.
Yeah.
These guys are
Yeah.
too
Exactly.
lazy to, and that's what sets apart people, I think. People who are willing to fly somewhere, pay a few $100s for a hotel room for a few nights, take time out of their schedule. It's a big barrier.
It
Most
is.
people
Yeah.
just want to stay in their boxers and type away on the internet forums and try to network. That
That
just,
and then you get addicted to all of that, and then you're wanting to go to every single one of them and meet more people and do more things, and I've found that a lot of those people don't take action afterwards, right? They just keep going and learning more and more, and I need the next thing, I need the next thing, I need the next thing, but they never implement anything that they're learning. That's one of the other things that you need to watch out for when you do get involved in that circuit, right?
yeah, just like
Um,
the like self-help books, right? Some people are
yep,
addicted to that thing, even though very little change or shouldn't take it.
yep, yeah, exactly. So you joined or you partnered with these high net worth individuals that you were I don't wanna say partnered, but you were brought underneath the wing of these other people doing the exact same type of things. Are you
Yeah, I learned about like I was going to the actions to do it myself,
Mhm.
like underwriting,
Yep.
talking to brokers. I think that's what really gave me a lot of confidence because maybe a newer investor, or at least my mindset was like, I don't know if I trust this operator,
Mhm.
but let me underwrite the deal. That's why we invest in real estate because if people have heard the analogy, the horse versus the jockey, where the jockey is the operator and the horse is the asset. If you have a good asset, you can have an idiot or a drunk operator, you
Mhm.
know, maybe not in the true sense, right? But in this world, that's really how these deals are driven, as opposed to today, I invest in like private equity deals outside of real estate. The operator is way more important. It's flip flopped as in terms of importance
Yep.
versus the asset or the idea in private. You can have a really stupid idea, venture capital, private equity, but if you have a good operator, it'll happen.
Yep.
But that's not the case in real estate. And in real estate, I thought, especially starting out, I was like, let me underwrite the deal, pull the rent rolls, pull the P&Ls, do my own comps and run it through my analyzer and see, hey, am I going to try? Are we really going to double our money in 5 years based on, I was able to verify performance. And initially I was like, let me just invest in this stuff as a passive investor and see what
Mhm.
happens. So I did a lot of that. And I also was a small part general partner, as they say, sit in the cockpit, but not in the driver's seat, just on the jump seat. Also a great way to learn too. And that was the way I rolled for a while. But when you, what I always tell my investors is be careful working with people under $1 billion of assets owned because they're
Mhm.
still a newbie, and what people don't realize is a lot of these groups that teach people how to do this, think of it as like the massage school or the beauty salon academy. Like my wife the other day was like, "Oh, there's this ad for $35 massages." I'm like, "Okay, first of all, that's a good price."
Yeah.
Right? Like how someone, oh, they're doing a 90-10 split where 90% goes to the passive investors, and then GP is only taking 10%, where most times it's a 70-30%, right? But I was like, heck no, I don't want no student training on me. But that's how some people think. They just go after splits and fees, and they're willing to invest with a brand new operator. I did that initially unknowingly, lesson learned, but I invested in a lot of operators and I realized, yeah, a lot of people just don't make it, right? They're not any good. They're just,
Hmm.
a lot of these training programs teach people more about how to present themselves on the internet and social media and take selfies than to actually operate the damn asset.
Yeah. Yeah. Yeah.
But that's it is what it is. I learned a lot through the process. I also learned a lot of the operas didn't pan out and relationships didn't pan out, but the ones who did, I still work with today. And we are lifelong friends and compadres. And I think, especially when your net worth ascends, that social relationships are the currency of the wealthy. But
Yeah.
aside from that, that was how I got started in this business, 16.
Yeah, that makes sense. When you were saying how the operator doesn't make as big of a difference in real estate, have you found that you're saying how with the I think you said private equity, but the PE firms, uh the operator does make the difference in those types of situations. Have you found that different types of real estate assets do rely more on the operator versus not really necessarily relying on the operator? Or is it really all about that particular asset is more important in your opinion?
Yeah, certain assets are different. I can only speak to what we do. We focus more on the workforce housing apartments and
Mhm.
in that world. I've invested in mobile home parks, self storage, all the standard food groups people have heard out there, but more as like a passive investor or more of like a secondary non operating GP. I would say, for example, mobile home parks, just to use that as a contrast. And a lot of the big thing is, although you say the word operator, right? The real word that we're talking about is asset manager, right? The
Mhm.
general partner. Now, in most cases, this is not necessarily the person who's boots on the ground. Sure, they may go out there from time to time, right? But they're not the person day to day. The person there day to day is the property management company.
Yeah.
Now, in residential apartments, you have an infrastructure of many property management companies and good ones. Um, Whereas mobile home parks, it's quite the opposite. A lot of times, the operator, general partner, needs to go hire somebody off the streets and train them to be a property manager in a mobile home park. Oftentimes, they're like a resident that cut their rent by 50% and they collect rents for you and do various things for you. So it's very different, more grassroots,
Mhm.
obviously, in that approach. So certainly in that asset class, the operator is a lot more hands-on. And that was, I guess that's maybe exposing a little bit of the multifamily operators world. In reality, I don't want to shortchange it because we do it, but like to go and buy a 200 unit, 300 unit apartment complex and operate it, it's not the hardest thing in the world. A few smart chaps like us who had no experience, you could do it. Obviously, we started small and 50 units, 60 units, class Cs, and then jumped up from there. We had some good successful projects with that and learned that class C assets, you can make a heck of a lot of money in that, right? That's where a lot of money's at, but it's also where a lot of headaches are at. A lot of those assets we ran at 80% collections, and that's just the name of the game in class
Yeah.
C world.
Yep.
So we kind of tried to step up to nicer assets as time went along. But as I said earlier, there's a lot of competition because everybody thinks they can go to a weekend boot camp and they'll go buy a 200 unit apartment complex. And they ultimately compete with us head on the bidding table. A little bit of Santa Claus isn't real kind of story here. Nothing's off market. Everything's on market.
Mm.
Some of these like guru groups, they teach these guys that they can write yellow letters to an operator or general partner or owner, and they'll sell the property for pennies on the dollar, like it's a little $40,000 single family home. No, bro, like that's a
Yeah,
waste of paper,
exactly.
a waste of time. That might work with your wholesaling boot camp training course for your single family homes, but not here. But we got to drawer foil these stupid letters. It just doesn't work. But all properties are pretty much move in the broker community, especially when we target more stabilized assets. So we don't like to go after anything less than 80% occupied. And
Mhm.
especially in that world. It might be a little bit wrong when you're dealing with more distressed assets. Sure, you can have a wealthy owner, net worth $5 million or greater, wanting to desperately trade that off market. But for the most part, things are on the broker community. So I guess that's to say that people out there need to understand that when you're dealing with these assets, a pretty liquid market and they're traded on market and anybody can get access to everything. And as long as you can qualify for the debt. Now, qualifying for the debt isn't the hardest thing to do. And when we dealt with this, we were established buying properties pre-pandemic.
Mhm.
And we're like, man, we're just getting beat by these newbies. And these newbies meaning these like big syndication groups of 7 couples, mom and pop couples, and they didn't know what the hell they were doing, and they were just all co-signing on the debt because they didn't have the net worth and liquidity, nor the investors to take down the deal, and they were just overpaying,
Mhm.
and we were hurt by that because they just pumped the price up on these assets. In 2020, we got the idea. I personally have the construction background as an engineer in my working days, and we started to think, how can we swim upstream, get away from the competition, the weekend multifamily bro to buying a 200 unit apartment complex. And that for us, it was development because the you always look for a barrier to entry in any business. Real estate's great because it's high dollar. You need a lot of money. But if people can raise capital, they can get over that barrier. But what they can't get over is the qualifications for the construction loan, right? It's relatively easy to get it for a large multifamily apartment complex in comparison to a construction loan because you actually need to do it. That's what we started to do. And in 2020, we started our first development and it, was a huge success. And we're like, wow, we need to add this to the arsenal, the product for our
Mhm.
investors. But I think that's a little speaks to that your question there. It's not the hardest thing for people to operate large apartment complexes.
Yeah. Well, how did you go about, especially getting started, finding the land? Were you only buying land that was already you already had all the entitlements and all of that done to it, or did you go through and just buy raw land and have to go through that whole process? So explain that thought process a little bit.
Yeah, obviously we like to buy things that is shovel ready, right? So
Mhm.
what you're talking about is we call it pre-development. So a land being ready to be, it's already zoned residential and it's all hooked up with the utilities in the right PUD. That's shovel ready. If it's not, what we'll probably do is buy the land, especially if we need to buy the land right away. And then maybe do a phase one syndication where investors come in and they're just landholders at that point. It's a lot lower risk and lower return. So then once we're shovel ready, then we go to phase two. And that's when we do the full blown syndication for the common equity at that point. So in the beginning, it's usually set up like preferred equity or like debt.
Mhm.
And then once we open up the project, obviously it gets a little bit more risky, but the returns go way, way up. So it's structured more like common equity at that point.
Got it.
For us, like I said, it's preferable that it's shovel ready to go, but you don't know what you're gonna get. And in our world, like we usually need a dozen acres plus to put a couple hundred units in.
Mhm.
So there's a huge shortage of that, especially when you're talking about building in. You're not going to find any infill locations that big. Not going to. So and you're also looking for places in the path of progress. So that takes away 99% of the
Yeah,
possible
yeah.
parcels out there. We got to take what we can get, right? So whether it's pre-developed, ready to go, whether we have to do it ourselves and take a year or two. There's operators out there that actually specialize in this. They never have done any construction themselves. They can just like they have and get a engineer to make up some silly drawings to get it to the pre-development stage
Mhm.
and say
Mhm.
and to
I know.
go and say, hey, yeah, you can build something here and this is what it looks like. Can you give me my entitlements and my zoning for it? They're adding value in the process for sure. And they get compensated for that and we've talked to a lot of those guys. We've never used them, yet because it just hasn't come up. Um, but I think a couple of times what we've done is we've bought the land contingent on the previous seller getting it to the zone correctly. So that's a way we've done it to make it on them to get it entitled. In a lot of those cases, you need to be local or be tied into the community to really expedite that. So usually, the people we buy the big tracts of land, they actually used to be ex-developers themselves, and
Hmm.
and they're usually retiring and they're older, which means that they have a good network and they're pretty tied into the community there. So it's better that they actually push this thing through than
Yep.
us.
Yep. You are also investing in the Midwest, or you've got some assets in the Midwest. Are you using the same strategy in the Midwest as well, or is this certain areas that you're focused on the development side of things?
I think that for us, the geographic locations are red states, red locations, obviously growing populations, growing economic drivers like the cluster in places like Arizona, Houston, Dallas. Huntsville, Alabama has been we got lucky with that one being a
Mhm.
tertiary market. And we also like to cluster our teams in the same area so we can
Yeah.
pull talent from one property to go help out another or train somebody. I think what a lot of people don't realize is property managers are really difficult to find. And
Mhm.
once you have one, a lot of what they do is not really learnable in school. It's more on the job training. And a lot of times it needs to be mentored. So if you have a good PM, go and mentor a junior one, that's a great situation to have. And you get that by having multiple assets in the same geographic location, maybe an hour away or less, something like that. But that's how we've done it. And we recognize we're not everywhere. There's probably maybe a dozen other MSAs that I think are great markets to invest in. We're just not there at that point. We switch hats to be more of a fund manager in that respect. And we operate certain assets and develop certain assets on our own. But say we want to go into a new market like Charleston, the Carolinas, just taking one off the top of my head, we want to go find a good operator in that one and partner with them because they've got the infrastructure built out there.
Got it, got it. So you're raising capital for other sponsors. You're also sponsoring/developing your own assets in certain MSAs, correct?
Yeah. What I've recognized is we can't do everything, right? We're not
Mhm.
going to go do mobile home parks, for example. We're not going to go do data centers on our own, right? At some point, you need to specialize in one as an operator. And also goes the same with geographic locations. You can't be everywhere.
Yeah.
But we want to give our investors the ability to diversify, right? Especially if you come with the framework of you're going to be in dozens of deals spread geographically and in different asset classes. And then now, especially where we do some manufacturing, private equity deals, we're obviously not the operator,
Mhm.
right? But we are the SPV manager applying the due diligence, the connection with the owner, and then providing oversight, accountability there. What makes us have that ability is we used to be operators.
Mhm.
We know all the lies and the stories and what happens. And I think what makes us good managers in that role and also makes us pretty damn good at due diligence on the front end. We've got the same tools, CoStar, Yardi at our disposal, and experience of owning all these assets in the past. And I think it opens doors for us when we're not just um, a family office that doesn't walk the walk. We can speak on an operator to operator level. And I think one example that came up, we were talking to this new group and we know what assets they own, right? It's all
Mhm.
in Yardi, right? We can use the hyperlink and pull up all their assets. We can also see the debt service coverage ratios on all their assets. And most cases, an operator like that will shy away from talking about that as they would with any retail investor, LP, who's investing less than $250,000.
Yeah.
I think that's what LPs don't realize is most good operators out there, the ones that are over a billion or $2 billion of assets, they don't want a little investor investing 100 grand or less. It's too
Mhm.
much friction. It's a lot of questions and headaches. And if anything were to go wrong, they're the most litigious because they don't understand this game.
Yeah.
They like to work with other operators who are on the same level as them, and they understand that things go good, things go bad. We're all a team at the end of the day. If things go wrong, maybe there's more resources that we can help out too, but we can read between the lines and ask the right questions. And in this case, they had some deals picked up in 2021 with flowing debt. And we know if that's the case, you're screwed. Your asset is worth 30% of what you bought it for at the peak. And in most cases, it's best just to drop the property.
Yeah.
And at that point, it's unfortunate for that part of the portfolio, but don't let it bring down the other dozen assets in the portfolio.
Yeah.
And that's something that we understand as operators, and that's the right business decision to do. And we also want to make sure that we're aligned with that operator to they understand that. Because there's a lot of new operators out there that they come to us all the time and they only have 4 deals. They might have a website that says they have $300 million of assets under ownership, which isn't very much. But with those 4 deals, they're just doing capital calls and just putting more money into the asset. But in reality, nobody will ever see that money come back. It's just underwater. They need a miracle for cap rates to come down a full percent point for them to be back in the money.
Yeah.
So it's
Yeah.
just not a good proposition. And yeah, I'll say it. Like if people are going through capital calls today, the only 2 questions to ask is what is that asset worth today? Which is hard to get because transaction volume is low and there's not
So,
many
yeah.
comps out there.
Yep.
And what is the senior debt? If you're putting your money in and the capital call under the senior debt, you never typically want to do that. It doesn't matter if that property is running at 90% occupied or 150% occupied. It doesn't matter at this point.
Yeah, 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 that's interesting. If someone wanted to, if a investor, an LP investor wanted to get into real estate investing, they've never done anything before, what would be the path that you would say that they should be paying attention to this or that first? And I'm taking this from a passive investor standpoint, not someone who's looking to be involved in doing the day-to-day type management and all of that.
Yeah, as a passive investor, you're never going to be like an underwriting specialist. That's just not in the scope of being a passive investor. What I would say, it's a bit of a chicken and egg thing. I think I'm a big proponent of network. That's why we run of a community of passive investors. That it's a pay to play thing
Mhm.
for obvious reasons. But I would say you need to get educated first, right? You need to be able to provide value or not just suck the air out of a room and ask stupid questions like what's a preferred rate of return? Like what's a split? Why is something not 92% occupied or not 95% occupied? Because normally you run these things at 92%. If it's 95 or above, your rents aren't high enough. Like
Yep.
you need to know these basic things so you can carry on conversations and not waste other passive investors' time. So I would suggest most people take a few months and just learn about like the maybe not the nuances, but the basics, the terminology. Like when you learn salsa, sure, you just get out there and move around a little bit, but you learn what is this called? What is that called? What are the basic moves? And I think apply that to this world. We have a free syndication e-course for our investors. If people want to take a look at that, they can go to the wealthelevator.com/syndication. I think it's 8-10 hours for more for LPs, but it teaches like the basics, like what is a good reversion cap rate that I should be looking for on these pitch decks, if it's
Mhm.
even on there. What's a good full occupancy, like I was mentioning earlier? What is the annual rent escalators that should be used? Not 3% or higher, maybe more like 2%. These are the things that really move the needle or the cells on the spreadsheet that you can really fudge to get whatever performance number you want.
Yeah.
Most investors, they look for like a threshold of doubling their money every 5 years in some of these cosmetic renovation projects in 4 to 5 years. But what I would do is understand what are the drivers of that model. And I mentioned a few of them. If you used a 5 cap rate, reversion cap rate, as opposed to a 5.5 reversion cap rate, that 100% return in 5 year pro forma is bogus. It really should be like a 60% return in 5 year when
Mhm.
you normalize the numbers what they should be. These are, I think, some of the bases I think in the number section, But then you obviously have to layer on top of the people section. And we actually have a full due diligence checklist, which I wouldn't recommend using verbatim, but it just allows you to know what
Yeah.
questions
Quick.
may want to ask, even though
Yeah.
you shouldn't ask them.
Yep. Yep.
But I think what this does is it prepares people to interact with other purely passive accredited investors. And that's where I spent a lot of money and time and energy to curate the room for people to meet high quality people face to face. And I think if you've gone through that e-course, I tell people have the confidence that you know more than most accredited investors out there. Because most accredited investors don't really know too much, even the ones that think they know on like the internet forums. In reality, internet forums are just, if you have 100 people and there are only 2 or 3 guys are typing, but
Yeah.
they really don't know what they're talking about because they're not operators. They're just deducting. Most times I'm seeing what they're writing and they're deducting the wrong thing from what an operator is doing. And then the 97% of the people are just newbies, flies on the wall. What we
Yep.
do is we educate everybody so they can get much more base knowledge than that that group. But then we put them physically in a room, and that's where, at least speaking from my experience, like interacting and building real relationships with people, organic relationships, not necessarily around the deals, syndications. Of course, we all investing and we don't want to, have the same values for the future. But cool things happen when you start to fly with people in the same trajectory. And I think it makes for fun events, especially when we curate the list that people come. Makes a great vibe and great energy. We're actually going to be doing one here in a couple weeks in San Diego. But I think that things really open up. I think we're talking earlier about my story, 2015. I was doing this all by myself,
Mm-hmm. Mm-hmm.
and my investing didn't move too much. But then I haphazardly met other purely passive or credit investors, and I started to learn about investing off of Wall Street and alternative investments to unlock the passive losses that drive my adjusted gross income, and then maybe applying real estate professional status and the infinite banking, the accredited investor banking, as we put it together. This trifecta of strategies is extremely powerful. And these are what I deducted by interacting with all these high net worth people. I've put it in a curriculum. That's been my passion project and putting it all in one place. But it doesn't come alive unless you have the people, the community aspect of it
Yeah.
all.
Yeah, I couldn't agree more. And I'm a big believer in joining those communities, just like you know, paying to join those communities, so that way everybody's on that same level playing field. And unfortunately, you have the other people that they think I'll just learn it all from YouTube, and I'm not going to pay for any type of education or anything like that. And you miss out on that community aspect, because that's really where a lot of that value is at. Is again being around everybody that's on that same level playing field.
Yeah.
So
Yeah.
that's
Amazing thing happens when you charge more than $5 to come
yeah,
to something.
yeah,
I had a buddy, he used to do those Rich Dad Poor Dad cash flow game events on Meetup when people actually used Meetup.
yeah,
This was a
yeah.
long time ago, but when he first started, he wouldn't charge for the events, and then he started to charge like $10 because they need to cover the room fee or pay for some soda or whatever. But then he had a guy who complained, like, "Why do we have to pay $10 to be here?"
Yeah.
And he got all pissed off. But that you attract an entirely different group of people when you got I call it the cheap, easy, free crowd.
Yep. Yep.
And I never really occurred to me, like when I first started growing through this personal development and also just financial skills, but there is a mindset part of it. I had Ken Honda on my podcast. I was a little unsure about bringing him on because I'm a little bit more pragmatic and numbers guy, and he's very opposite, right? We're both Japanese, but he's a lot different than I am, and he's very spiritual, which I was wondering how it would go. But a lot of the things he said, being loose with your money. Some people who are very tight with their money. And I started to think and I was like, yeah, I don't like to hang out with them. Thus far, I don't really hang out with people like that these
Yeah.
days.
Yep.
You know,
Yep. No, that
the
makes
people I like to hang out with are people who have money and spend it like it's going out of style. They know that time is the most important thing and money is just money.
yeah.
And they
Yeah.
know that, and they have I think that's the difference. They have the
That
confidence
that
that
they
they
can get
spend the
more.
money, they put the money out, they're going to get it back
Yeah.
tenfold in money or social relationships. Where some people, especially We're talking at the earlier part at the top, there are the salary guys, W-2 jobs. And that's where I was for a long time, where you get a fixed annuity, a paycheck coming in every 2 weeks, but it's just a different mindset. And some of these guys, they're great people, don't get me wrong, but they're not very fun, I guess is the word,
Yeah.
but they're
Yeah. Yeah.
just playing small ball in a way. I like to hit
Yeah.
home runs and have a good life and live big, pretty frugal still. It's boring to watch baseball when they're just bunting all over the place, you know?
Exactly. You mentioned a few minutes ago about the self-development and self-help type things, and that kind of ties in very well into the segment that we were talking about earlier, the life crafting segment of the show here. If I was to ask you, what is your highest ROI activity? And again, that can be personal, that can be business. What would you say that your answer would be to your own personal highest ROI activity that you do?
Yeah, good question. I got to think about this. I still just run around all day and put out fires, to be honest. Yeah, I think when I talk to most business owners, I'm in Vistage and EO, and the
Forgot
theme
about
that
that.
comes
Yeah.
up a lot is hiring people. People grew great businesses, and a lot of times just getting lucky, finding the right person seems to be the common thread.
Mhm.
So I'm gonna say spending time cu- curating a good list of people that work for you.
Mhm.
Although that's very hit and miss, and you can put a lot of time into something and just not find the right people, or who knows, that could be my fault too. But I can only do so much, I think, is what I realize. And I'm going to be running around putting out fires and also once in a while looking up and doing the big things, working in the business as opposed to working on the business. Or maybe I got that backwards. But as soon as you can start to bring other people in with better expertise in certain areas, I think that's the biggest.
Have you ever heard of the book Buy Back Your Time by chance by Dan Martell?
No,
It
but
it's
I get the
fantastic.
gist of it by the title.
Yeah, exactly. It's a fantastic book about hiring, and it shifted my thoughts on this. I've been an entrepreneur for 25 years and had all kinds of different people, but never really looked at it this way. But buying back your time, it's just such a slight little change in the way that you're approaching that hiring process that it's impacted me quite a bit in our processes and what we're looking for and the different goals and objectives and all of that type of stuff. So, highly recommend that book if you haven't read it.
Yeah. I think now we got a full team, but I do remember just to give people some practical advice with that if you haven't gotten on that road to doing that. I think 2017 was when we started to hire virtual staff.
Mhm.
And you can ease your way into it. You can get a Philippine VA that speak great English. You never know if anybody's there sometimes because they have like hurricanes every week and the
Yeah.
internet goes out. It's a lower dollar investment, like 20, 30 grand a year can get you a small team or a good person. And you can start from there. And I think that's the biggest thing is like, where do you get started? Just like a rental property. Like
Yeah.
you just starts with the first rental property and you go from there. But the first one is the hardest one, whether it's a rental property, a syndication deal as a passive investor, or somebody you pay $6 per hour to do
Yep.
some of your stuff for you. I think, and I do remember how daunting it was for me because I was cut from the cloth of man, like 20 grand after taxes to pay this person was a lot of money to me at one time. Right? That's what script and saved and never ate out on a Friday, Saturday, Sunday to save
Yeah.
for a good part of my life. And now I'm just going to put it out somewhere. But that you got to have faith. And I think intuitive, you understand that that's going to bring you a higher ROI. If not, that's on your head. That's your fault.
Yeah.
But it's easier said than done. And I think you got to get in there and just do it, get that proof of concept for you.
Yeah. No, I couldn't agree more. Lane, if somebody wanted to reach out, learn more about you or any of the services or anything like that you offer, what would be the best way to reach out and get in touch?
Yeah, if they're a podcast listener, check out the Wealth Elevator podcast. Been doing that since 2016. If you're new to my content, I would say just pick up my book, The Wealth Elevator. I think it pretty much encompasses everything I talk about in terms of investing as a accredited investor. I have a great pull-out chart in there where you see what floor of the wealth elevator you're on. right? If you're on the first floor, like where I was in my 20s, buying little rental properties, then once you become an accredited investor, there's the second floor and it tells you what to do investing, retirement account wise, privatized banking wise, taxes wise. And then there's a couple levels above that.
Hmm.
So I think I set out to make a book that wasn't just about mindset, like the Rich Dad Poor Dad book with very little actionable advice, but a book more predicated on, hey, there's these different levels and paradigms to this wealth building journey. The advice of one person in one certain stage or floor in this case is very different from the next floor. And I didn't want to lose sight of this. And yeah, I think most of the books out there are written for people who are just getting started. You need
Yep.
a
Yep.
budget. You're trying to get above $100,000 net worth. Not the book for you if that's for you, unless you want to really see what's in the future. But that was what I saw or what I learned going through this transformation process myself. So that's the book, The Wealth Elevator. And if people are interested, also email Lane, thewealthelevator.com.
Excellent. Lane, thank you so much for all of the insights and sharing the experiences and all of that. So it's always great to be able to talk to other people who have been there and actually done it rather than going through and listening to people who haven't actually experienced all those different situations. So thanks for sharing today.
Yeah, thanks for having me. Thanks, Matt.
No problem. And that's a wrap for today's episode of Invest in Square Feet. I hope you found our chat with Lane as insightful as I did. Remember, investing is a journey and staying informed is your best compass. Ready to take the next step? Check out Lane on wealthelevator.com/syndication for a free e-course and more to boost your success. Or come and check us out at investinsquarefeet.com. I'm Matt Shields, and until next time, keep investing in your future, one square foot at a time.